But some failures define an entire era. Lehman Brothers was one of those failures. It became one of the major investment banks in the United States, into mortgage finance and securitized products, heavily exposed to real estate and dependent on short-term wholesale funding. When Lehman filed for Chapter 11 bankruptcy on September 15, 2008, so it did not just mark the collapse of one institution. It became one of the defining moments of the global financial crisis. Build up the crisis. To understand why Lehman collapsed, we need to go back to the build-up. In the early 2000s, easy credit and low interest rates fueled a major US housing boom. Lenders originated more and more mortgages, including subprime mortgages that were often weakly underwritten. These mortgages were pooled into mortgage-backed securities or MBS and into more complex structures such as CDOs. As long as home prices kept rising, the risks seemed manageable. Investors chased yield, and rising home prices helped hide the fragility of the system. But once home prices started to fall, delinquencies and defaults surged, and the hidden risks began to surface. Why Lehman was vulnerable? Lehman was vulnerable because it combined three dangerous elements: large real estate exposure, high leverage, and fragile short-term funding. The firm had major exposure to both residential and commercial real estate. It was not only creating and distributing securitized products, it was also retaining large portions of them on its balance sheet. By 2007, Lehman had an asset to equity leverage ratio of roughly 31 to 1. That meant even modest declines in asset values could create severe pressure on equity. But the bigger weakness was funding. Lehman relied heavily on repos and other short-term borrowing to fund long-term illiquid assets. So when confidence weakened, lenders pulled back, haircuts rose, and the firm faced a classic liquidity crisis. The collapse. As mortgage assets deteriorated through 2007 and 2008, losses mounted rapidly. Lehman tried to raise capital and sell troubled assets, but the pressure kept increasing. Potential rescue decisions, including talks involving Barclays and Bank of America, did not lead to a solution, and unlike some other institutions, Lehman did not receive a government backstop. Then came the breaking point. On September 15, 2008, Lehman Brothers filed for bankruptcy. This was not just about bad assets, it was about a collapse in confidence. Once the market no longer trusted Lehman's balance sheet and funding position, time ran out very quickly. Why the failure shocked the system? Lehman's failure shocked the system because Lehman was deeply interconnected with the rest of the global finance. It had relationships with banks, dealers, funds, repo lenders, and counterparties across the market. Once Lehman collapsed, the problem was no longer only the firm itself. The real question became who is exposed and how far the damage spread. That is systemic risk. That is contagion. The bankruptcy triggered counterparty risk and settlement uncertainty. Money markets, repo funding, and credit markets came under severe stress. Fire sales and forced deleveraging pushed prices lower, and the panic spread quickly through the global financial system. Aftermath and policy response. After Lehman failed, the panic intensified across global markets. One important event was that the Reserve Primary Fund broke the buck after exposure to Lehman paper, which further damaged confidence. Authorities then moved aggressively to prevent wider collapse. AIG was rescued, central banks expanded liquidity support, and governments launched broader stabilization programs, including TARP and various guarantees. So Lehman's collapse became a turning point. It forced policymakers to respond much more aggressively. At the same time, it rephrased the debate around crisis management, moral hazard, and the question of when authorities should intervene. FRM students, Lehman Brothers is not just history, it's a classic risk management case study. First, liquidity risk can destroy a firm before capital is fully exhausted. Second, high leverage amplifies losses and quickly erodes confidence. Third, securitization does not eliminate underlying credit risk, it only transforms it. Fourth, stress testing must include funding shocks and market liquidity. And finally, Lehman reminds us that systemic risk is really about interconnectedness. One institution's failure can spread through the network and destabilize the entire system. That's why Lehman remains one of the most important examples of systemic risk in action. Hi guys, in this documentary I tried to break down step by step the Lehman Brothers case. The goal is to help you to understand what happened, and I tried to make it simple so that you can memorize it and be ready if this case appears in your risk management or FRM exam. Good luck.